Good morning, ladies and gentlemen. Welcome to this session. My name is Kaori Iida. I'm the senior editor of the Economics News Division at NHK Public Television, which is based in Tokyo. The title of this session is The New Normal of Emerging Markets. In the past years, we've seen the super cycle of commodities and the rise of the middle class accelerate the growth in emerging markets. But with low growth and low interest rates, or the new normal, the critical question is, what megatrend will drive emerging markets investment in this environment? And we have a wonderful panel today. I'd like to introduce Professor Nouriel Roubini of New York University, and Yinglan, venture partner with Sequoia Capital, and Dr. Kevin Liu, who is partner and head of Investment Solution Asia at Partner Group. We'll be talking about where potential growth can be found, what new investment and opportunities there are, and the role of technology and digital disruption. And of course, a bit about Brexit. I'd like to start with you, Professor Roubini. Set the stage for us. You travel extensively, you talk to a lot of people. How do you observe the current situation in emerging markets?
Well, I think probably the starting point has to be first what's going on to these economies before we discuss what's going to happen to their financial markets. Emerging markets had a very strong decade of economic growth between 2003 and 2013. And associated with that strong economic growth, there was also a period of time where asset prices like equity returns in emerging markets were also highly positive. Since 2013, things have changed somehow. I would say, first of all, we cannot generalize. There are some emerging markets that have stronger economic, financial, and policy fundamentals. There are some of them have weaker ones. Take, for example, even the BRICS. Within the BRICS, two countries today are in a recession, Russia and Brazil. One is barely growing, South Africa. One, China, is in a structural slowdown, growth closer to 6% in my view, potential growth in China probably closer to 5%. And the only relative stronger performer within the BRICS right now is India, that based on official data is growing 7% plus. Now, if you had to generalize, probably I would say the following thing. There were three global tailwinds that supported emerging markets, GDP growth and asset prices in the decade until 2013. One was that China was growing around 10%. The second one, that there was a commodity super cycle. Mm-hmm. And the third one was that after the global financial crisis, policy rates went to zero in advanced economies, and you had unconventional monetary policy like QE, and therefore money searching for yield that was zero in advanced economies was going into emerging markets. Those three global tailwinds are now becoming, since 2013, headwinds. China is not growing any longer 10%, at best 5-6%, a bumpy landing. The commodity super cycle is mostly over. In part because of the slowdown of China, but also because in the years where prices were high, new supply came to the market through new capacity. And however slowly, the Fed is now done with QE, and however slowly it's going to exit zero policy rates. And starting with the taper tantrum of 13, money started to flow out of emerging markets. So you have now three global headwinds. Second factor, in the boom years when money was easy flowing in emerging markets, some emerging markets, not all of them, had loose monetary, fiscal, and credit policy. They ran twin current account and fiscal deficits. Inflation rose above target, and growth started to slow down. It was the fragile five, but also a bunch of other emerging markets. Some other emerging markets have stronger macroeconomic fundamentals, but those that have a weaker one now have to adjust. Tight monetary, fiscal policy, credit policy, and you'll have the slowdown of growth. In some cases, outright recessions, like Brazil, like Russia, and so on. And final factor, potential growth has fallen in emerging markets, in part because they have not followed those kind of structural reforms that lead to an increase in potential growth, with few exceptions, maybe Mexico, maybe India. And a number of these emerging markets actually moved away from market-oriented reforms towards models of growth based on variants of state capitalism, things like excessive role of state-owned enterprise in the economy, excessive role of state-owned banks in the allocation of credit and savings to investment, resource nationalism, import substitution, industrialization, protectionism. So potential growth has actually, because of this policy, fallen. You know, Russia had this model of state capitalism, China in part, India before Modi, of course, Argentina, Venezuela, populist countries. Argentina has changed, and even Brazil followed that model. So the question is, which kind of emerging market can now restore structural reform that are politically difficult, even in emerging market, whether they are more democratic countries or less democratic countries, because the structural reform imply short-term cost and medium and long-term benefits. Some of them will be able to do so. Some of them, the political economy reform implies they're going to do less so. So that's the macroeconomic context for these emerging markets.
I'm feeling a bit pessimistic right now, so I want to turn to Kevin. Kevin, from a business and private equity perspective, how do you see the investment landscape evolving in emerging markets?
Right, thank you for your question. I think when you look at emerging markets, right, we as investors, we always try to distinguish between the short-term factors and the long-term factors. Particularly for sort of a large private equity firm like we are, we manage $50 billion on behalf of 800 institutional investors, and we cannot afford to be blinded by short-term factors. So here, let me maybe elaborate a bit, especially after what Nouriel has mentioned about the three sort of headwinds that he talked about. I believe that for emerging markets, by definition, because these are newer, that's why they're called emerging markets, right? By definition, I think they are more vulnerable for short-term shocks, whether it's commodity, whether it's other negative. So that is a given. I think nobody's going to argue that a typical emerging market country would be more strong in terms of when you compare to OECD countries to handle those shocks. However, if you look at the long term, from an investment angle, you see a number of drivers that are fundamental, right? Everybody talk about urbanization. China, where we are, is a great example of that. When you have 500 million people who will be moving to the city, it just create a lot of opportunities for investors like us and the growing middle class, part of that. I would also add a point which is less talked about, which is the whole late mover advantage, right? When you have a catch-up situation for emerging markets, in a number of aspects, including technology, which is inland space, where you have a catch-up situation when you are a latecomer, actually sometimes that allow you to go straight to the best technology. That would also apply to many other aspects, even including the softer things like the whole model for development, right? So a lot of the emerging markets countries are at a fortunate position. They don't have to take it for granted. Some of the traditional wisdoms that has been done in the OECD countries, they could experiment other things. So from investment angle, from our side, emerging market is clearly part of our asset allocation globally, and we particularly like middle class sort of theme. We like global linkages. You know, whenever we buy a emerging market company, usually what we do is to link it closer to the rest of the world, whether other emerging markets or OECD countries. So we believe there is value you can find, even today.
Yinglan, from someone that's looking at technology and startups, what is your observation towards emerging markets?
Sure. I think, thank you for the question. And I think we don't think of ourselves as investors in tech startups. We think of ourselves as business partners who help companies build enduring institutions for years to come. So we take a very long-term view of company formation, and we partner with them to recruit, hire, among other things. But I would just segue and talk about three sort of observations in emerging markets. I think one is that there's a global dichotomy of capital flows. So I think the power law is accruing to fewer and fewer players. With the sort of slowdown in the tech venture capital market, companies that has proven unit economics that is shown to create value. I think Trevor mentioned about Uber's creating value in the cities they are in and creating real utilization improvement. Those companies will still get access to capital. Those will still do well. I think it's the second spectrum is the unmasking of companies with less proven unit economics. I think that those companies will tend to struggle. So that's point number one. I think point number two is the connected world phenomenon. That used to be the case where US companies or European companies will just win US and Europe and maybe Australia, and they may say emerging markets are second priority. But now if you draw a circle around Asia, China, Japan, India, Indonesia, more people live inside the circle than outside the circle. As a result, US companies like Airbnb, like Uber, they realize they need to win the circle, win within the circle. They need to find players who can help them win the circle. They need to find investors or partners who can help them win the circle. The global firms need local investment managers or local operations or local CEOs to help them win the circle. And as a result, they need to conform their business practices and business models to win in emerging markets, such as what Airbnb, Uber, and a bunch of other companies have done. I think the third trend is that we see a emergence of new disruptive business models in emerging markets that has surprised us positively. I think we have a saying that there's three kinds of companies. There's clones, and there's mutants, and there's new species. Clones are companies that take proven business models in the West, and bring them to emerging markets. And this you will be mindful that industrialization happened in developed markets 40 years ago. Industrialization is happening in emerging markets only recently. So there's a whole spectrum of interesting companies that has popped up. There's new disruptive models. We call them the mutants and new species. So mutants are taking business models in the West, but adapting them to local requirements. One company is example, which is an interesting one, is a company called Gojek, which is on-demand motorcycle app in Indonesia that not only delivers people, they deliver food, they deliver groceries, they deliver masseuse, and they deliver even makeup artists and cleaners to your home. We see interesting companies emerging from countries like Cambodia, Vietnam, Indonesia as well. I think the third one that we find most exciting is the new species, which is the companies that are formed as a result of local requirements and local phenomena that only is found in emerging markets. Companies that take into account of e-commerce transactions and telco data to make loans in real time on the cloud. I think these are some of the new species that we are seeing. So that sort of summarizes my take on tech in emerging markets.
Okay, great, thank you. On Brexit, Professor Roubini, you famously predicted the US housing crash and the financial crisis in 2008. With the Brexit approaching, are we going to see another financial crisis or a global recession?
No, I don't expect a global recession or another global financial crisis. I think that the shock that comes from Brexit is significant, but not of the same size and magnitude as the one we had in 2007, 8, and 9. However, I would say is a major significant financial shock, as the reaction of the markets on Friday suggested. It creates a whole bunch of economic, financial, political, and also geopolitical uncertainties. It could be, I'm not saying it's going to be, the beginning of disintegration of the European Union or the Eurozone. At some point in the future, the Scots might decide to go for another referendum, and it may be the breakup of the United Kingdom. Then the Catalans in Spain might say, me too, and that might lead to a breakup of Spain. Some of the Nordic members of the European Union might say, without the UK, the European Union is mostly the Eurozone, so what's in for me? Sweden, Denmark, and so on. And as we know, there are lots of economic and political fragilities within the Eurozone. There is austerity and reform fatigue in the periphery. There is bailout fatigue in the core. There is a rise of extremist populist parties of the extreme right and extreme left, both in the periphery of the Eurozone. Uncertainties tomorrow. Spanish election, what happened in Italy with the local election, Greece, Portugal, and so on. And now even within the core of the Eurozone, there is a rise of parties that are anti-Euro, anti-migrant, anti-Muslim. You have seen it in Austria, in Germany, in the Netherlands, in Sweden, in Finland, and so on. So I think that there'll be a huge amount of uncertainty, and the Europeans will have to figure out whether they want to go towards a more integration of Europe and more integration of the Eurozone, even if the voters are becoming increasingly skeptical about giving power to Brussels and the center, or whether there'll be more variable geometry and let more autonomy of nations within Europe and the Eurozone, but then having less of an integration that might be needed to have complete the monetary union. So I think these sets of economic and political uncertainties are going to bear on economic growth, are going to bear down on financial asset prices. They're going to create a significant amount of uncertainty in Europe, and through trade and financial contagion channel, of course, the repercussions could be into the United States, into emerging market to some degree. So it's not as severe as 2007, 2008, but it creates a huge amount of economic, financial, and political uncertainty.
If I can follow up, that uncertainty, what would that mean for emerging markets? Will we see capital flight and capital flowing out of emerging markets, for example?
We don't know yet. The market responses on Friday was more severe in terms of equity markets in Europe, in the UK, in the US, rather than the typical emerging markets. Of course, some of these emerging markets in this risk-off episode has seen also some weakness of their currency, some widening of their spreads, like in the periphery of the Eurozone. There's a question of how much, British banks that are keen in global financial intermediation over time might be willing and able to intermediate further flows of capital, some of which are going into emerging markets. There could be some reduction of those intermediation and inflows. But I think that many of the channel transmissions are going to be also through sentiment. If there is another major risk-off episode, and we had two of them in the last year, one August and September of last year, driven by the worries about the Chinese hard landing, the second one in January and February of this year, driven not just by concern about China, but about US growth, about the Fed, about all energy and commodity prices, political risk in Europe, global banks as BOJ and other central banks went into negative policy rates. So there was a whole set of things that led to this mini perfect storm in January, February that reversed. Brexit, together with other concerns in the market. Today there are worries, as I said, about the future of Europe, politically, economically, and financially. There is a slowdown of growth in the US and job creation has become more anemic. There are uncertainties about what the Fed will do. There are still question marks about how much economic growth in China is slowing down and how much reforms are or are not in the back burner. There are concerns about Japan and what the BOJ and Abenomics is going to be. Some of these emerging markets are still fragile. This risk-off episode might lead to another rundown of all commodity prices negative for emerging markets. So usually get 3 or 4 factors that interact together, then lead then to a risk-off episode like the last two that led to a 10% correction on a temporary basis of global equity markets. On Friday the response was pretty sharp. We'll see whether that's going to continue. There's a risk that's going to continue. It's going to lead then to that financial weakness, and then the question is going to be how much you get economic weakness and how much you have a policy response by major central banks to try to counteract the effects of this shock. And those things are all uncertain as of now.
Kevin, we heard from Professor Roubini about the economic, financial, political, and geopolitical uncertainty. How will that uncertainty affect the sentiment of investment towards emerging markets?
Yeah, on Brexit and other uncertainties, as I mentioned earlier, I think by definition, emerging markets are more vulnerable to this type of shocks. So I think if there are investors who choose to be exposed to that added vulnerability, if you want to sell low and buy high, that's their choice, right? In our case, we're fortunate, we're a long-term investor. Our programs and funds tend to have 10, 12 years of life horizon, so we can look beyond the short-term vulnerability, either in reality or in the perception, right? So for us, from an investor's perspective, clearly, right, when you have a shock like this, that there is a negative impact on the GDP growth for UK. I think economists are debating about how big that is. There's no debate about whether there will be a reduction of their projected GDP. So for us as an investor, a global investor, we certainly look at our assets in UK very carefully. I think we are going to adjust some of our assumptions in a very modest fashion. But on the other hand, I think this shock also, especially the perception of bigger shocks, also creates investment opportunities, right? I'll be very specific. For us, Partners Group operates in a very wide range, right? We do primary, secondary, direct investment, private equity, debt, infrastructure, real estate. So clearly, I think what's happening in UK these days creates at least 2 opportunities that I see. One is in the debt space. I think it's likely to see some global banks to take a more cautious stance in terms of their financing. This is a place we play as well. We have invested over $12 billion in private debt in the LBO situation. So we might actually see more opportunities away from those banks. And another point, very, very obvious for us, is the secondary business. This is essentially a sort of private equity secondary or real estate secondary is how we provide liquidity to the LPs who essentially want to fly up to quality, which that's their choice. And when they choose to do those things, actually it's a great opportunity for us to actually invest in assets which may otherwise be unavailable. So I think there are clearly, if you look deeper, if you play a wide piano as we do, right, there's always some keys you can play.
Yinglan, we heard from Kevin that uncertainty creates opportunities.
Sure.
Can you weigh in on that?
Sure. A few points to add. I think one point is that I think largely my point of view is that advanced economies grew largely dependent on finance, but I think emerging markets grow largely dependent on fundamentals. The rising middle class, rising smartphone adoption, the quest for a better standard of living, and I think those forces long term won't change. Right? I think the fundamental tenets won't change. I think having said that, I think one of the few things is that the jittery in the markets will probably push out short-term or myopic investors, which actually is favorable for long-term long-term investors, long-term entrepreneurs who want to build enduring companies. Because I think the cost of the capital, the capital is available and to entrepreneurs who want to build good companies. Less competition, the factors of production are cheaper, and there's more talent available. I think the second point is that the cost of starting a business, especially a tech business, is less than before. With cloud computing, AWS. So actually, the power has shifted away from finance and financiers like us towards the entrepreneurs. So I think as we see a more jittery markets, it's actually a great time for founders to start new companies. We invested in LinkedIn in an economic downturn, and I think we'll see probably many more fantastic companies to be started in the next few years.
Professor Roubini, we heard from Kevin at the outset that urbanization and late movers advantage will be the driver for investment towards emerging markets. What megatrend will drive emerging markets investments from your point of view?
Well, certainly, if one wants to take the medium long-term view, there are many positives still in a number of emerging markets. As was pointed out, urbanization, industrialization, late mover advantage of adopting new technologies, rise of a middle class, rise of a consumer society, and with that demand for goods, services, consumption, real estate, transportation, and also, significant amount of infrastructure needs in many of these emerging markets. So those are all positive medium-term trends that one should keep in mind. I would say, however, the kind of headwinds, mega trends that emerging markets will have to face are several. One is there's been a significant increase in debt and leverage also in emerging markets. And now there's a process of deleveraging that's going to be painful. The deleveraging started first in the US, then in Europe. The third leg of it has been now in emerging market. And that process of deleveraging can last 5 to 10 years, as we know, in those countries that had excessive debt. Secondly, when you are very poor, you mobilize labor and capital, you have some macro reforms, you can grow very fast for a while. But when you reach middle income status, as we know, there's a risk of a middle income trap, because from that point on, you need to increase actually productivity growth. And to do that, you need much more R&D, innovation, technological, and others. And only a subset of emerging markets, based on the World Bank, have been able to successfully move from middle income to higher income. The good news is that some of them are in Asia, Hong Kong, Singapore, Korea, and that bodes well for other countries in Asia, like China and others. The bad news is that only 10 or so countries that are emerging market out of 100 plus have been able to go to the next step. And the challenge of doing the kind of structural reform that increase productivity growth is bigger than just mobilizing labor and capital when your incomes are low. And then there are these bigger kind of mega trends that there is right now, I would say globally, as we've seen from the Brexit referendum, there's a bit of a backlash against trade, against globalization, against migration, and even I would say against technology, because some of these technological innovations are capital intensive, skill bias, and labor savings. And therefore, the question is how much more protectionism could occur in Europe or the United States. As we know, in the US, Donald Trump has said he's not going to ratify TPP, he's going to slap 50% tariffs against Chinese goods and so on. Hopefully he's not going to be president, but there's a mood in the nation of people that have been hurt by trade and globalization and migration and so on, and the backlash can occur. And that backlash, as we've seen in the UK with the Brexit vote, and in Europe where unemployment rate is much higher than the US, and the UK is even more severe. So the question is how much there'll be a backlash against trade, against globalization, against technology, and one of the first victims may be some of these emerging markets. And finally, on emerging market, I would say in the last decade, some of the stock market return were driven by strong GDP growth, strong earnings growth, and releveraging that increased the return on equity through essentially leveraging up of the corporate sector. Today, GDP growth is slowing down, earnings growth has been a sharp slowdown, and their ability to leverage actually is limited. If anything, they'll have to deleverage significantly, so increasing return on equity through leverage is not going to be possible, and that might be, again, a headwind to returns on, say, public equity markets in a number of these emerging markets.
Kevin, did you want to jump in?
If you allow me, maybe I can challenge Professor Roubini on one point on this whole issue of globalization versus backlash, right? I think that is, to me, that is sort of a black and white way to look at it, right? It's like Brexit, you're in or you're out, you're may or leave. I think the world we live today is far more nuanced, right? The way I see it almost is that today, if you look at the sovereign countries or markets, right, you can argue philosophically that there are basically multiple borders, right? There's a border for the flow of capital, there is a border for the flow of people, there's a border for the flow of knowledge, and there's a border for sovereignty. And I think what's happening today, whether it's pro-globalization or anti-globalization, Brexit or not, is simply some small changes on some of those borders, some of it getting a little bit more porous, sometimes it's not. So I don't see the world as black and white, as we used to live in the globalization world for the last 20 years. Now people decided that this is no longer good. I think it's simply which border you are talking about, because there are flows of many, many things. And I suspect that's going to be an evolving picture going forward anyway, which is why for us as an investor, if we find a smart way to capitalize on that, find the right trend for that particular set of borders, then you might find opportunities to invest.
Point made. I think we had a stimulated conversation. I'd like to open the floor to questions. If you have a question, please raise your hand. The gentleman in the front.
A question for Professor Roubini. This low interest rate environment that we see today seems to be somewhat like riding a tiger. We've gotten on it. And what might be the implications as the world gets off it? In the financial world, there is this thought, a bad economy, a bad US economy is good because it keeps interest rates low, which means asset prices remain high. And that obviously is not sustainable. So what's your comment?
Well, I mean, we've ended up in a world in which monetary policies have become extremely unconventional and remain unconventional because the growth recovery in advanced economies is doing extremely anemic. And other policy tools in order to boost economic growth, like fiscal policy and structural reform, have been constrained. Of course, structural reform have to occur in order to increase potential growth, but there's also an issue of aggregate demand. And since fiscal policy being constrained by large deficit and debt, by market discipline, by the rules of the EU about fiscal consolidation, by a political gridlock in the US that doesn't allow for greater fiscal stimulus, central bank became the only game in town, to use the title of the recent book by Mohamed El-Arian, and therefore the job of sustaining growth and aggregate demand has gone in the direction of only using mostly monetary policy. I would say the optimal policy mix would have had slightly less reliance on monetary policy, greater reliance on fiscal stimulus and accelerating structural reform, but the political economy of structural reform is that whether in advanced economies or emerging market, in a democracy or less democratic country, these things occur always much more slowly than is desirable and optimal. So that's the situation we're in.
Thank you. My question is as well for Professor Roubini. If you compare with other emerging markets, where does China stand in terms of structural reforms? There's a lot of talk, about SOE reform, but nothing much happened. So,
well, I would say that there is a bit of a trade-off between accelerating structural reforms and accepting a lower growth rate, and a bit of a political imperative of trying to maintain a growth rate high, and therefore maybe kicking the can down the road and slowing down the process of those structural reforms. And I think there is a bit of a tension between those, even within China, that are more reformers who are worried about the overinvestment, about the overcapacity, about the over-leverage, about many bad assets and bad debts. We're saying we have to deal with all these issues, because if we don't deal them, we create greater financial vulnerabilities. But if we deal with these issues, then we have to accept that growth over the next 5 years cannot be 6.5%, because deleveraging and adjusting implies accepting the fact that potential growth probably is closer to 5%. But then there is a political imperative, given the MPC decision, to try to target growth at 6.5 for the next 5 years, to maintain growth at that level. And to do that, every time there is a slowdown of growth, you have to double down with another round of credit-fueled fixed investment. That means more bad assets, more bad investments, more overcapacity, more bad debts, and so on. And that dilemma has not been fully addressed. And I would say, at the margin, I would think that right now, because of issues of social stability, employment, and so on, there is slightly greater emphasis given to achieving the growth target. That means that some of those reforms are going to occur much more slowly than will be desirable. In the short run, that stabilizes growth. Over the medium term, it creates financial vulnerability, make the landing of China more bumpy than would otherwise be.
Kevin, would you like to add something to that on China structural reform, where you see China currently?
Yeah, I would simply add, I largely agree with what Professor Roubini has talked about. I think I would simply add, I think if we look at China's structural reform, the question is, in my mind, is, number one, do you want to do it? I think the answer is yes. I think that's very clear. There's a consensus in Beijing. They want to do it. Number two is, do you have the domestic and international environment that are conducive to this? So here you could argue that 10 years ago probably was a better time for the Chinese government to start some of those reforms, because at that point I think the international environment was a bit more conducive. I think the growth was faster. Today I think both international and the Chinese growth story are less strong as before, right? So you would argue that today, that's why I think, as Professor Roubini talked about, I think it's more difficult for them today to push through structural reform in a more aggressive manner. But I do not think there is any disagreement in Beijing today about the necessary sort of steps that have to be taken, which, by the way, and China is not alone, right? I mean, Japan needs structural reforms, US needs structural reforms, many European countries need structural reforms as well. And relatively speaking, I would not say the Chinese policymakers are more timid than the other policymakers. I would say this reality is the other way.
Do we have more questions? Sir.
Thank you. I'm with the German financial daily Handelsblatt. I have a question to Professor Roubini and Mr. Liu regarding the structural reform in China. One of the defining aspects of the structural reform in China is this notion that demand in future should be largely provided by domestic companies, which has been perceived very worryingly by international companies. So what does that mean for interaction with China if, for example, in the robot sector by 2025, 70% of the demand is only being supplied by domestic companies? What is a sufficient reply, and how do we counter now increasing demands for protectionism? Thank you.
Well, if you take at face value the reforms that are being proposed by the Chinese authorities, there is a sense that there'll be a greater role of domestic demand, but that domestic demand can be satisfied either by other advanced economies and emerging markets exporting more to China, goods and services, especially consumption, and or through foreign direct investment that Western companies could be doing in China to boost also their role in satisfying the domestic demand. So emphasizing domestic demand doesn't mean that that domestic demand should be coming only by Chinese companies. Of course, there is a little bit of a concern that China, while it's talking about opening up and actually opening up even further is part of the official strategy, may implicitly but not explicitly favor domestic champions, either state-owned enterprises and or firms in the private sector in satisfying the growing demand that is going to come from Chinese consumers for these goods and services. And there is an intensive dialogue that the US, the Europeans, and others are having to make sure that there is not going to be a bias towards a domestic champion, whether public or private sector. And that's an ongoing source of certainly concern among some of the foreign companies.
Yeah, maybe two quick points. They are interrelated. One is, as Professor Roubini mentioned, the domestic consumption is clearly going to be a bigger focus going forward for the Chinese economy in terms of growth, right? But if you look at the numbers, right, today the contribution to the GDP growth in China from household domestic consumption is in the mid-30s. This is what the United States was in 1920s, roughly, right? So the China is lagging behind in a very significant way in terms of the share of contribution to GDP from domestic household consumptions. That's why, in my view, the only way is up. However, it's a very long journey, right? If you look at countries that have gone through their development stages, it takes them decades to take from that ratio to what US today is about 70%, Korea is 50%. It's going to happen. It's a long journey. My second point, though, is that for what Professor Roubini also mentioned about the whole industrial policies, right? I think if you look at countries, at different stages of development, almost all countries have done that before in terms of trying to promote the domestic champions. Many, developed countries today still do that. And so I think here is just where they have the wisdom to find the balance, sector by sector, sometimes company by company, to achieve that policy objective at the same time trying to open, right? If you live in China, you will know reform and openness has been the slogan for the last 40 years. And I think that is a driving factor. Whether in the short term they want to dial back in certain situations, I don't think that's going to stop China from reform and being open.
I think I saw a hand on this side. You have a microphone.
Thank you. Sjoerd Daas with the Dutch Financial Daily. I have one question for Professor Roubini as well. You were talking about the European disintegration. Countries are asking themselves, what's in it for me eventually, the European Union? To take that one step further, do you think this is the beginning of the end of the European Union and one step ahead even the Eurozone, because this could shape a precedent? What would you say to investors that are considering to invest in either a Eurozone country or in the UK? Should they be heavily invested in euros, or should they be worried again that the Eurozone might face a breakup in the near future as well?
Well, I said at the beginning there is a risk. It's not my baseline that eventually the Brexit may be a trigger of a process of disintegration of the European Union and even of the Eurozone. I would say in the case of the Eurozone, actually, one of the possible responses that Europe could have is to say that, without the UK in the European Union, then, European Union becomes closer to being the Eurozone. Because you have already 19 members and some of the Central East Europeans eventually might want to join. Probably you'll have to wait until after the French and the German election to have a move forward towards greater banking, fiscal, economic, capital markets union, and eventually political union. But even that move after those elections is dependent on finding a consensus on those issues, and there is not a consensus on that one. So, and I think that there'll be a bit of a tension because some federalists in Europe are going to say, let's take what has happened in the UK as a reason for going for greater integration of Europe, to complete it even further than the past, to make sure that there is a resharing, there is a fiscal union, and so on. And other people say no, the voters are increasingly skeptical of giving more power to Brussels and the center. There is a bit of a democratic deficit. There should be slightly more degree of domestic and national autonomy. We should go even further towards a variable geometry of the European Union. That's the only way we keep it together. And if you force integration in a way that the people don't accept in an environment of high unemployment, then the backlash might lead to other countries deciding to vote otherwise. Even a country like yours, like the Netherlands, the recent referendum on Ukraine suggests that there are forces that are actually becoming skeptical of the European Union and the Euro, and the same forces are seen in other parts of the core of the Eurozone or even the periphery. So I think that the debate within Europe on whether more integration or more variable geometry is a way of making sure that both the European Union and the Eurozone survive and thrive is going to be a debate that just started. And I'm not sure what's going to be the answer to it. But you have to give an answer to make sure that you don't get eventually disintegration.
Kevin, you've been talking about opportunities in emerging markets. Can you give us a sense of what specifically you're talking about in terms of region and in terms of sector?
Sure, yeah. Maybe let me just first clarify. Partners Group is by no means a emerging market fund, right? So we manage 50 billion. What we do is that actually only about 12 to 15% of our assets are in developing countries. And so what we do is something called global relative value, right? So we look at the relative value across countries, across geographies, across sectors at any point of time, and then try to find opportunities there, right? So from that angle, emerging markets has always been part of our allocation. It will always be, regardless of those short-term vulnerabilities to different shocks. And in China, for example, we are very focused on the growing middle class, right? The last acquisition investment we did was a company called Yinglan a few months ago. This is a baby product retailer in China. And we believe that type of company where you have direct sort of exposure to the growing middle class would do very well if you manage them properly and if you link them to the global sourcing and markets properly. I would also add, maybe on China, then I'll quickly talk about emerging markets overall. The other big thing we focus on China is actually investing in other places, but with unlocking China value in mind. Because these days, any large assets you have, let's say $1 billion plus assets, is always a China angle, right? You can source more from China, you can partner more with Chinese players, you can sell more products in China. That to us is a very, very important themes as well, very specifically. And related to that, we actually work very closely with strategic LPs in China for those assets, and we will announce maybe later this week a major buyout in France, and where we are leading a consortium which includes a very large Chinese investor. The idea is not only to use their capital to do that buyout, it's also to work with them in a strategic fashion to unlock the value of that French asset in China. So related to China, on emerging markets, certainly I would only add that I think infrastructure is something we looked at very closely. For example, we own the second largest gas pipeline company in Mexico that is actually transporting gas from Texas back to Mexico, which is part of the, very consistent with part of the energy openness policy of the government. So clearly, in emerging markets, as I mentioned, you want to find that connectivity to the rest of the world. I think you want to find synchronization between your business objective and the policy environment. And in the case of Mexico energy, that's something we found. And so this is an asset we believe we're going to generate 20% IRR, even for infrastructure asset.
And then we heard from Professor Roubini on the backlash from trade, globalization, migration, and possibly on technology. Do you feel that?
Yeah, sure. I mean, we see this quite a bit. But having said that, I want just to applaud the Chinese government. We have maybe slightly less than 500 portfolio companies in Asia, and maybe 200 plus are in China. And I would say the Chinese government is actually very supportive in terms of regulatory reform towards tech companies. And you think about, the analogy of a soccer. If the government official is a referee, the entrepreneur is the player, and venture capitalists like us are the player coach. I think it is important to have clear rule of law, clear rules, and also for the rules to evolve with how the pitch, the soccer match is being played. And I think for new companies, new disruptive companies with emerging business models, it's very important for regulations to catch up with how the business is developing. And I would say, emerging markets, is sort of more open compared to developed markets, which is open, fixed norms to conform to new business model requirements. I think the other factor is that one interesting observation is that we have seen very disruptive business models, in particular in Southeast Asia, where we have seen models in China, in India, being used to come up with new disruptive business ideas. So, for example, Tokopedia, which is a long-tail e-commerce marketplace similar to Taobao. I mean, they serve more than 100,000 transactions a day. But I think they take the lead from the Chinese model and take a lead from the India model, and they come up with a new disruptive model in emerging markets.
Lastly, to Professor Roubini, I'm going to ask you if you're more optimistic about emerging markets after this conversation.
Well, I think, medium long term, there is a lot of economic opportunity in emerging markets. And if you think about it, the potential growth in advanced economies is as low as 1% or less in Europe and Japan, maybe close to 2% in the United States. In emerging market, until 2013, the average growth was 5-6. I think potential growth probably has fallen now in the 4 to 5% range. And given the leveraging, probably actual growth for a few years is going to be below that one. So it's going to be a period of probably economic slowdown for many emerging markets. And I think the question mark for most of them is going to be which one of them are going to do one, macroeconomic stabilization, which one of them will have the political institutions to then accelerate the kind of structural reform needed to increase productivity growth, and therefore which one of them are going to be then able to avoid a middle income trap. Some of them are going to be successful, some of them are going to be less successful, and therefore there is lots of opportunity, and as we pointed out, you cannot generalize. There'll be countries, sectors, and individual firms that are going to do well, and others are going to do less well, and therefore there is a vast opportunity on the upside, as much as there are some risk on the downside.
Okay, I think we all acknowledge that there is a lot of uncertainty ahead, but still, emerging markets are still dynamic and a great place to invest. Thank you, and please join me in thanking the great panel.